You're tuned in to More Living with Jim Brogan, broadcast live from the Brogan Financial Studios at News Talk 98.7, where old-fashioned values, expert knowledge, and genuine understanding come together to give you the retirement straight talk you deserve. Jim's a former National Advisor of the Year recipient and a financial educator, and he's here today to talk about how you can live out the best years of your life. Jim and the Brogan Financial team have been helping retirees and pre-retirees across the Southeast for over 20 years in their pursuit of financial independence. You can reach them during the week at 865-862-6800. So sit back, relax, and get ready to learn, because More Living with Jim Brogan starts now.
Hello, East Tennessee. Welcome to More Living with Jim Brogan, where it's all about living the best years of your life your way. This is News Talk 98.7 WOKI. And, you know, when I think of East Tennessee, we live in such a great place here. And one of the great things about East Tennessee is how our economic conditions don't fluctuate as wildly as other markets around the country. And that's also true with real estate. Local real estate prices don't seem to be as susceptible to especially corrections and pullbacks in the market as some other markets. Now, of course, that doesn't mean that we don't have pullbacks in the market, not at all. That doesn't mean you don't have risk with local real estate. But certainly our area of the country, we're very blessed here in East Tennessee with a stable economy. Now, on the same point, real estate can be a very, very effective investment asset class. Now, you can do that certainly by owning local real estate. You can also do that by investing in real estate all over the country and even all over the world. So I'm often asked, Jim, what's the best way, or what are the different ways that I can invest in real estate? And I do think real estate can be an effective diversification tool. Believe it or not, real estate is not as correlated to the U.S. stock market as you might think. It is correlated. I mean, when the market's up, more often than not, the real estate market is also up. But it's not always like that. And, one of the things I talk about with diversification is you want to own a lot of stuff that if one thing zigs, another thing zags. And that way, if one thing, like stocks, are way down, hopefully they're not all way down. To me, real estate is a fundamental investment asset class that most people should have as part of their diversified portfolio. Now, you could also invest directly in real estate. So it certainly continues to be a hot topic in today's world. Locally, real estate has exploded, especially residential real estate has exploded in value over the last 5 years. So should real estate investment, how should you factor it into your financial plan, and how can you invest into real estate? So fundamentally, we do at Brogan Financial classify real estate as an alternative asset class. And I mentioned the diversification. When one thing zigs, another thing zags. So, there are often markets where real estate values do move differently than stock market values, and over time, real estate has provided attractive returns. So, how can you most effectively invest in real estate? Now, there are different ways to do it. Of course, one would be direct ownership. With direct ownership, you invest directly into owning either all or part of a property. So the most common thing that I see is rental property. Now, you've got long-term rentals where you manage a tenant with a longer term, typically at least a one-year lease. And then by contrast, short-term rentals often involve direct ownership in vacation-type properties and destinations. And of course, in this area of the country, we see a lot of that in the Pigeon Forge and Townsend and up in the Smoky Mountain area. So with direct ownership, there are pros and cons to that. So certainly one of the pros is income, especially if you own the property with no debt. Now, that is also a factor to be considered, because when you factor in the debt, Debt on a investment real estate can be a very powerful thing because it leverages your potential return. In other words, you don't have to put as much equity into it. You could maybe own 30% of the property, but you get all of the appreciation of the property. Now, then you do have debt expense, right? But if you're doing it for income, be careful that you don't overestimate what that cash flow would look like if the rental home is not paid for. Now, if it is paid for, or if you're thinking, hey, while I'm in my working years, I'm going to just be cash flow neutral or close to it, maybe a little bit in the green. But then later, as you get close to retirement, the debt gets paid, then it can be a very reliable income source. And then you can also get the capital appreciation of the real estate. There are also tax benefits because you can write off depreciation, well, which you'd want to talk to your CPA about, but you can depreciate that property over time to be able to offset profits. Now, there is a tax consequence if and when you sell, and I'm going to cover that a little bit later in the show on this Real Estate Saturday. Some of the cons of direct ownership is, number one, it can be very illiquid. You may not be able to sell quickly if you need cash. And then the other is the cost of management of the property. See, either you're going to have to pay somebody to manage the property, or you are going to have to manage the property, or maybe some combination. And I think oftentimes we don't put a proper value on the value of our time. Having a direct ownership in real estate where you manage the property, we really can't compare the true net return on that rental as compared to a passive investment where we don't have to manage it, whether that's stocks, mutual funds, bonds, or passive real estate. So it is important to understand the value of your time and how that affects everything. Okay, now then there's also indirect ownership, which I'll get into here in a minute. Now you can also invest in into real estate trusts. Real estate trusts allow investors to expand their real estate portfolio without the hassles of owning physical property. So this would be indirect ownership. Investment monies are pooled by a real estate investment trust company, also called a REIT, R-E-I-T, which then manages, buys and sells properties and then passes on a share of the profits to the investors. So this would be indirect ownership as opposed to direct ownership. Public real estate trusts are traded on national stock exchanges. So there are two types of REITs. There's public REITs and private REITs. Public REITs that trade on national stock exchanges makes them easily accessible to investors. They're also regulated by the Securities and Exchange Commission, which requires regular disclosure of detailed financial information. And that type of regulation often bolsters the transparency and security of the investment. Now, because they are actively priced and traded, they are potentially volatile investments day to day. But that's one of the things. Public real estate trusts provide daily valuations of each share. They're valued at the end of every day, so you know what your investment is worth, and it is typically liquid because you can sell those shares on the exchange just like you could a mutual fund or anything else. Now then there are private real estate trusts. Private real estate trusts are investment entities that are not listed on national exchanges. And they're typically only available to what are called accredited and institutional investors. And I'm not going to go down that rabbit hole too much, but there are income qualifications to be considered an accredited investor, and there are also net worth indicators, net worth not counting your primary residence, that can also be used to determine if you are an accredited investor. Many, if not most of the investors that we serve at Brogan Financial, most are accredited, over half are accredited investors. Because private REITs are not actively traded, the investment is considered largely illiquid. You can't just get out of it anytime you want. Now, the management of the private real estate trust can often invest, however, with more agility and with a focus on longer term returns because there's not that focus on liquidity. It therefore may offer the potential for greater returns. However, greater returns are not guaranteed, and as we know, they could result in greater losses, but they are not as liquid. There's also less regulation of private real estate trusts and may make them riskier. And because they do not receive daily valuations, you don't often have a true picture of what the shares are worth. And I can't tell you how often I see this, where we have someone come into our office and they have a private REIT and it hadn't really been, that you really don't know what it's worth because it's not priced on a daily or even a monthly basis. Now, they might price it and have it appraised annually, or there could be different mechanisms for that, but you really don't know what the capital appreciation or depreciation is. You're just doing it for the income. I mean, you're doing it for capital appreciation, but you really don't know what's going on there because you don't know the true value of it. So in my view, private real estate trusts, due to the reduced regulation and transparency, just come with much greater risk that must be carefully considered prior to the investment. So we have direct ownership where you actually buy and either manage or have the property managed for you. And then you have indirect ownership. And one of those ways is the real estate trust, REIT, and there are both public and private REITs. Now, when we come back from our break, I'm also going to talk to you about mutual funds and ETFs and other considerations that I think you should be thinking about when you look at investing in real estate. So stay with us. This is More Living with Jim Brogan right here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Welcome back to More Living right here on News Talk 98.7 WOKI. I'm Jim Brogan, and we're talking about real estate as an investment and the different types and ways to invest in real estate. And in the first segment, I talked about direct ownership where you buy the property and manage it like a rental property or whatever. And then there's also indirect or what I would call passive ownership. I do want to mention just a few other things on actual direct ownership that I do want to be sure that I cover. I mentioned it can be a liquid. You have to value the cost of your time. You can't compare actively managing a rental property and looking at the return on that, the net return. You can't really compare that to a passive investment like a stock or a mutual fund or even passive real estate. Also, you don't want to underestimate how much you need to know about the market you're buying in. Many don't realize how much time it takes to develop expertise on the market, whether that's a long-term rental here in Knoxville area or if it's a vacation rental up in the Smoky Mountains or even at one of the beaches in South Carolina or Florida. You need to become an expert on that market. Now, we did a town hall for clients earlier this spring on buying a second property. And we hosted a realtor who specializes in the Emerald Coast down between Panama City and Destin, Florida, which is one of the most popular beach areas and vacation areas for the beach for people from East Tennessee, especially Middle Tennessee. And one of the biggest misconceptions we discussed is the investor's view of cash flow and income, and that many people enter into direct ownership with false expectations. So there are some additional consideration regarding income. Will you need debt to finance the purchase? Because as I mentioned in that first segment, anytime there's a mortgage, net cash flow expectations decrease dramatically. And there's a difference between net cash flow and net income. So it's very, very important that you have the cash flow you need, and you also have to manage the net income for tax purposes. What is your rent income expectation? As a rule, you'd like to get gross income, gross rents from the property of about 10% per year. For example, if you own a property worth $250,000, gross rent should be close to $25,000 per year. Now, this is prior to any expenses, taxes, insurance upkeep, and potential management fees. So then that comes off of that money. But ideally, now in that area of the country, it's so hot down there on that Highway 30A area between Panama City and Destin that it's very difficult to get 10%. It's maybe around 8 or 9, but that's the type of thing you should be considering when you're, in my opinion, and I'm not a realtor, but that is something I think you should consider when you're looking at, if you're thinking you want to do a short-term rentals in a vacation destination, look at the current home prices and then also what are the gross rents that they're paying. Now, in the real estate jargon, they call that the cap rate, the capitalization rate, but it's basically the gross rent divided by the value of the property, and you want it pushing 10% ideally. I mentioned the value of your time. That's often overlooked, but then we should talk about diversification. If the rental property is a substantial part of your net worth, you should consider the risk of a collapse in that real estate market that you own in. Likewise, if you own several properties, but they're all in the same geographic market, then there's a concentration risk to that geography that could upset your financial plan. So, there are great benefits with direct ownership, but there are also some drawbacks and some things that need to be carefully considered. And I would say cash flow and net income is one of the biggest things, because are you going to need debt to finance the purchase? And then how does that affect cash flow and net income? Now then, on the passive ownership investment, I mentioned public and private real estate trusts, or REITs, R-E-I-T. There are also mutual funds and exchange traded funds that can give you exposure to real estate investment. Mutual funds and ETFs also offer that ability, and because these types of funds trade daily, they are both liquid and you get a daily price, so you know what it's worth. They're also subject to the same regulation as other mutual funds and exchange traded funds, so there's a good bit of transparency there. Many real estate funds invest primarily in public real estate trusts. However, there are some that also invest in the stocks of companies that have exposure to real estate, which could include things like home and commercial builders, real estate supply companies, cell phone towers, and other companies that have exposure to real estate investment. And that's one thing that I like in diversified real estate. The real estate trust industry is, last I saw, a little less than half of the entire passive investment real estate market. Well, what about the other half? That would be some of these other opportunities would be included in that. And so, if you're using a fund, look at the diversification in the fund. Are you limited just to a fund that buys public REITs? Does it do more than that? Can it invest in other stocks? So, ultimately, I do think real estate is an alternative asset class that may provide good diversification and balance in an investment portfolio. It also may provide regular income. There can be tax benefits of investing in real estate. Now, choosing between direct and passive investment can be very complex and should be considered as merely part of your overall financial plan. And, of course, that's what we do at Brogan Financial. Now, I want to pivot a little bit. Is 2024 a good year to buy a home? So, a very interesting question. Few thought home sales would kind of fall off a cliff, and they did in 2023. They dropped about 17% from the high in February to their low in October, according to the National Association of Realtors. Now, we didn't see that type of drop in East Tennessee, and that goes back to what I said earlier in the opener, that our economy is more insulated from corrections than most areas around the country, and that includes the real estate market. But we did see a decline in real estate prices last year. Most thought that home prices would not increase by much. Let me back up for a second. I think I said that wrong. home sales dropped about 17%, not home prices. Home sales dropped by 17% around the country, but prices did continue to climb last year by about 7%. My apologies, I was getting mixed up there. So basically, prices continued to go up. Home sales went sharply down by 17%. And this has all combined to create the least affordable housing market probably in a generation. Sales of existing homes dipped below 4 million units. Those are levels that were last seen in 2010. But yet, because of the fewer buyers, home prices kept climbing because there weren't enough homes on the market and competition pushed prices higher. So that's a phenomenon we've definitely seen here in East Tennessee because interest rates are so much higher now, which makes affordable homes more difficult. And so you would think home prices would plateau or even come down some, but there's such a low inventory of homes. Not many people are selling. And will that picture improve throughout the rest of 2024? I think, we'll have to see how the year plays out, but I do think that there will be a gradual improvement in home sales around that. Now, I'm talking around the country, where volume starts to click up just a little bit, and maybe a little bit of easing the price structure because of the low supply, where there's not such an escalation in the next couple of years of home prices. Now, there could be sudden surges or big swings in the market, so you do have to be careful with that. Will rates come down? Mortgage rates have already fallen a little bit. The Federal Reserve's historic campaign to rein inflation in through interest rate hikes has had a powerful impact on the housing market because even though prices haven't come down, demand has come. It cut demand so much because rates have surged, and it's pushed would-be home buyers out of the market. So you have new home buyers that are not currently owning that. They can't afford to do it now with the home prices escalating and then with the interest rates where they are. And then people that already are in a home and have a mortgage at 3% or 3.5% interest, they don't want to move out of that home and finance a new home at 7% interest. So it has created a lot of pressure on the home market. Now, in October of last year, a typical home buyer would have spent more than 40% of their earnings on their mortgage payment. That is an all-time high according to Zillow. Zillow's data stretches back to the 1990s. So 40% of the average home buyer income goes to pay the mortgage. So as mortgage rates, I do think if later in the year and into next year we see a reduction in mortgage rates, I do think more homeowners who have been clinging to their ultra-low mortgage rates, we may see more homeowners put up their home for sale. So I expect that the real estate market around the country will continue to be fairly strong. It may cool off a little, and I expect more home sales to start picking up as we get deeper into the year and into next year because of some of these market forces. So bottom line, is 2024 the year to buy a home? Maybe, maybe not. You've got to consider, I'm not a fan of you having 40% of your income go to a mortgage payment. I think that's too much. And I think sometimes we get real set on, do I want to rent? And if I'm renting, I'm just throwing my money away because I'm just paying it out to somebody else and I don't own anything for it. There can be benefits to renting. And one benefit is you just have a lot more flexibility. And you can wait for interest rates to drop and for the housing market to cool off a little bit and get into the housing market when rates are a little bit lower. Also, in the early years of a mortgage, especially if you do a 30-year mortgage, almost all of your payment is going towards interest. in those first few early years. So to me, the flexibility of renting and not locking in a high interest rate is not the worst thing in the world. Now, if you do buy and you have a high interest rate, you can always refinance when that interest rate goes down. And there are ways to refinance with no closing costs. Now, that does add a little bit to the interest rate that you're paying, but the bottom line is if you can do all that and still have an interest rate lower than what you currently have, then refinancing can be a valuable tool. So, I think if you're in a current house, you've seen an escalation in your own home value. So, but you might want to move. If you want to upsize, you've got to very carefully consider that. What's the mortgage going to look like on the new property? Yeah, you're going to, people say, well, I don't want to buy now. The properties are escalated, but the home you're selling is escalated too. So the interest rate issue to me is the bigger issue. So you just have to carefully consider all of these things when you look at buying a home. Now, if you are downsizing, because we get that a lot with people that are retired or getting ready to retire, they're thinking about downsizing. And I don't mean necessarily downsizing in size, although that is often the case. Are you downsizing in price? Because if you are downsizing in price, I personally think it's an absolutely great time to look at doing that, because you're going to get a premium for your house. And if you're downsizing to a less expensive house, you're going to see more of that premium on the sale of your house. And then hopefully you have enough equity in your house to be able to pay for the downsized home in cash, and maybe even have more money, more equity come out of the house that you can invest now for retirement income. So I think 2024 is an okay time to look at buying a house. I think there are going to be better opportunities as we get into 2025 and 2026. However, prices may continue to escalate, so we just never know. Now, when we come back, handling real estate as an inheritance. How are you going to handle even your primary residence when you pass away? What happens? And is your home a terrible inheritance for your kids? So stay with us. This is More Living with Jim Brogan right here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Back to More Living with Jim Brogan, where it's all about living the best years of your life your way. We're with you every Saturday from 9 to 10 a.m. and again from 3 to 4 p.m. right here on News Talk 98.7 WOKI. You can also check our podcasts of all our shows. You can either go to broganfinancial.com and click on radio and listen directly on our site, or you can use your favorite podcast app, Spotify, Apple Podcast. Just put in More Living with Jim Brogan. You can pull us right up. As my goal with this show is to provide great information and teach things to you that maybe you either haven't heard or haven't understood in the past, so you can make informed and prudent decisions that can impact the quality of your life. Now, is your home a terrible inheritance for your family? And what do I mean by that? So in real estate in general, any kind of real estate, you've really got to carefully think through the inheritance implications when you pass away and they go to your kids. But let's focus in on the house first. Many consider their house to be the largest or second largest asset, and in many cases it is, with the retirement accounts being the other, the IRAs, the 401ks, the 403bs. With the escalation of real estate values over the last several years, this issue with the home being the first or second largest asset has become an even bigger estate planning issue. How should you plan to leave your house to your family? You know, handling your house and other real estate has become a big issue, especially if you have multiple children or beneficiaries. How will your family handle your house? What if one child wants to keep the house, but the other wishes to sell? One is going to need to buy out the other's interest. This can create a cash issue. where will the funds come from to buy out the other sibling? If most of the other assets are retirement accounts, then there are significant tax ramifications for cashing in these accounts for the sibling that wants to buy out the other sibling. Let's say there's a $200,000 property, and well, let's say 300. Let's be more realistic, and the 150 is needed to buy it out, and it's mostly retirement accounts. Well, to get $150,000 out of a retirement account after tax, you might have to pull out 200, 225 because of the tax bite. And that could be very problematic. There's also an issue of valuation. How are you going to value the house? If you get a fair market evaluation, is the person paying for half the home, is that child going to feel that's fair? Is the child going to feel like they should be getting a break because it's mom and dad's house? So there could be really a breakdown in communication and in relationships. If there are more than two children involved, it can become even more complicated, as each child may have a different objective as well as different cash needs. So how can you manage this issue? I think the key is effective communication. Are you speaking with your children about your plans for your estate and for your house especially? Have you discussed with them their goals when it comes to inheriting real estate? Estate planning in today's world is even more complex. Family communication was one of the biggest keys, especially when it comes to real estate and other real assets. Now, when you own second homes or rentals or vacation homes, you can have even more complications in inheriting or leaving those to your kids. Let's say you've got a beach condominium in South Carolina, and you have two kids. Typically, a lot of times what happens is you leave that to your two kids equally 50-50. And the type of ownership they have is a different, usually, let's say both kids want to keep the second property, the vacation condominium. Typically, the kids will have a different kind of joint ownership than you have on your home with your spouse. See, the home you have in your spouse is called joint with right of survivorship. And basically what that means is if one person dies, the other person automatically owns the home, just legally. Usually, if it's passing to two people who are not husband and wife, like two kids, it usually is a different kind of joint ownership called tenants in common. And it could be any split. It could be 50-50. It could be 60-40. It could be 72 and 28. It could be any mix. But let's say it's 50-50. What happens? So each kid owns half. What happens when one child dies? Their half goes to their kids, not to the other owner. And that may sound like a good thing, but if these are adult grandkids, now you've got three people that are owners in the property. One owns half, the other two own 25% each, and then when the other sibling dies, now you've got even more owners of the property, and it can become really, really sticky and messy. So again, it's family communication ahead of time at dealing with these kinds of things. I think I cannot indicate strongly enough how important that is. I tell you what, we're going to go ahead and get to our last break. And when we come back, I want to talk about all the tax and probate issues of dealing with real estate, because there are quite a few. And how can you reduce the tax exposure on your real estate? So stay with us. This is More Living with Jim Brogan here on News Talk 98.7 WOKI.
Welcome back to News Talk 98.7's Brogan Financial Studios, where Jim Brogan is coming to you live with important news and advice to help you achieve your dream retirement. Get ready to learn and live. Here's your host, Jim Brogan.
Thanks for tuning in this week to More Living. I'm Jim Brogan. You're listening to News Talk 98.7 WOKI, and I'm talking about real estate investment. We've talked about owning your home, the complications with inheriting real estate when you leave it to your kids, and the extreme importance of communication, especially when there's multiple children. In this last segment, I want to talk about some of the tax opportunities in real estate or the tax risks in real estate, and also want to talk about some of the probate issues when you pass away. So first off, let's talk about the tax implications of real estate when you sell. One of the things that's really come into play more and more here in the last 3 or 4 years is the tax implication of selling your primary residence. You know, it's interesting because 5 or 6, 7, 8 years ago, I very rarely ran into instances with my clients where they had to worry about capital gains tax on the sale of their primary residence. And now we're getting that problem all the time. And it's because of the tremendous growth and escalation of real estate prices. So the way that our Internal Revenue Code is structured, when you sell your primary residence, if you are a single filer, you get a deduction of essentially $250,000 from any gain in the price of that home. In other words, if the gain in the home is more than $250,000, that would be over what you've paid for it. And if put into the house, which you need to have good records, what do you have in the home? Repairs don't count. Home improvements do. And if you get into a murky area there, just please talk to your CPA. But, you know, if you have $250,000 in your house and it's worth $600,000, that's a $350,000 gain. So if you're a single filer, you get to deduct $250,000, but then, or is exempt, maybe is a better way to say it, but then you have to pay long-term capital gains on $100,000. Now, if you're married, you get an exemption of $500,000. Again, it has to be your primary residence, and there are some rules for that, how many years you have to have lived in it in the past 5 years. Talk to your CPA about that. But $500,000. But I am seeing more and more issues, as I said, with people selling and getting more than a $500,000 gain, and there's really not much you can do about it. I mean, you cannot do a 1031 exchange with your primary residence. A 1031 exchange is where you set up a 1031 before the house is sold, and basically the proceeds of the home sale go into an intermediary account. They don't go into your name, they go into an intermediary account, and then as long as you buy a new home within a certain time frame, you have to identify the new home potentially, and then also buy the new home with certain different time deadlines. So there's a lot of rules to that you have to follow. But when you do a 1031 exchange and you buy a new piece of real estate, you don't have to worry about the long-term capital gain. But we're not allowed to do that with our private residence. So really about the only thing you can do there is try to document not just what you paid for the house, but any home improvements you've made. And keep all that stored somewhere. If you've not done that in the past, I recommend you do it now, so that if and when the time comes, you've got all that stuff documented. And then, of course, any expenses associated with the sale of your house, those are also deducted. So that, those are deducted from your long-term gain. So that would be, of course, closing costs on your side, the main of which would be the realtor commission. If you hire a realtor, that is deducted from the amount of the long-term capital gain. But it is very important to realize now that with the appreciation of these homes in East Tennessee, there's potentially tax exposure when you sell your primary residence. Now, some of the benefits of real estate ownership is depreciation. When you're investing in rental or other real estate for business reasons. So if you got rental real estate, you can depreciate that house. Let's say it's a rental home. You can depreciate it. Most CPAs I've heard talk about this do what's called a 20-year straight line depreciation. So every year, 1/20th of the value of that house is deducted from income taxes. Now, there is an income tax implication, though, when you sell the house. So, let's say that, just to use round numbers, let's say that I bought a rental home for $100,000. And over the last 10 or 15 years, it's grown to $300,000, but I've depreciated it down to zero. So in other words, I paid $100 for it, but then I've been depreciating it every year, let's say at $5,000 a year. And after 20 years, my tax basis at that point is zero because I've depreciated, which means I'm going to owe tax on the entire $300,000 sale price. The first 100,000 of that is considered a recovery of your tax basis, and that is a higher rate than long-term capital gains. It's not as high as, well, it's 25%. So in some cases, it could be higher than your ordinary income. In most cases, it's not, but it's 25%. Then the growth from 100,000 to 300,000 is a long-term capital gain. So it's crucial to really understand how you're going to be taxed on the sale of property. Now, you can do, as I mentioned earlier, there's this thing called a 1031 exchange, where you exchange the property, and when you sell the house, you have to set that up before the house sells. Let's say it's a rental home. The money goes to an intermediary, and then you can buy a new property and not have to pay the capital gains tax. So you continue to defer that capital gains tax. Also, if you own property or multiple properties that let's say you just don't want to manage them anymore. So you want to be out of the real estate management business, but you don't want to pay the big capital gains tax. You might have something that's appreciated tremendously in value. You can actually do a 1031 exchange into a vehicle that is passive ownership. And it's kind of like a real estate trust, a private real estate trust like I talked about earlier in the show. But you're passively invested. And then you can typically get, and then you defer the capital gains taxes. And you could probably expect a passive income of 4.5% or 5% off that real estate. But there are risks because those real estate values of that real estate trust, it's called a Delaware Statutory Trust, a DST. But the real estate values in that DST can also go up and down, and so there's risk. There's also appreciation potential. But that has to be very, very carefully considered because a DST is going to be more illiquid, but it gives landlords the opportunity that are tired of the maintenance issues of dealing with rental home ownership to be able to become passive real estate owners without the headaches and without the capital gains. And then one other thing that I do want to talk about is what happens when a spouse dies. Let's say a husband and wife own a home, and it is escalated in value, and one spouse dies. What is the tax implication if that spouse wants to sell the house? So what happens is, if you own something jointly, this could be true with a stock as well, but let's look at the primary residence. If you bought your home for $200,000 and it's now worth $500,000, that means if you sold it, there is a long-term capital gain of $300,000. Now, at death, there's what's called a step-up in tax basis. So at death, the long-term capital gain implication basically goes away. But if it's only one spouse that dies, only half of that long-term capital gain goes away. So it leaves the other half to the surviving spouse. In Tennessee, you can actually create something called a community property trust. And if it's done properly, and that's something that you definitely need to use an attorney that understands the Tennessee rules for community property trusts. But basically, if you have an appreciated asset that you paid $200 and it's worth $500, when one spouse dies, there's a full step up in tax basis. So it goes all the way up to the $500, and now the surviving spouse could sell without really worrying about much tax implication. So it's a very important consideration. Certainly a lot of retirees like the thought of retiring on the house if they're going to downsize in price. That can provide a lot of much needed money for income planning. But how we deal with our house and our real estate, are you invested in real estate? And if you are, how are you dealing with the inheritance implications, the tax implications? Is it the diversification needs? All of those things become critically important. Today on More Living, we've been discussing real estate and the economic impact and investing in real estate and some of the pros and cons, because greater wealth provides for more living so you can live the best years of your life your way. Thank you for tuning in this week. I hope you have a great week. In the meantime, check us out at broganfinancial.com. Click on resources. We've got a lot of blogs, a lot of articles, a lot of guides that we've written that can give you great information to make informed and prudent decisions to impact the quality of your life. Thank you for tuning in this week. Have a very blessed weekend as you've been listening to More Living here on News Talk 98.7 WOKI.
The views expressed by Jim Brogan and his guests are not that of Cumulus Media. Any discussion of financial, legal, and tax planning strategies is not intended to be individualized advice and is general in nature. Always consult with your advisor for advice specific to your needs. This program's content does not represent a recommendation of any particular security, strategy, or investment by Jim Brogan or Brogan Financial Incorporated.